Right now, Amazon is bleeding billions of dollars in cash, and Wall Street is terrified that the company has finally pushed its spending way too far. If you just look at the surface-level metrics, you see what looks like an undisciplined tech giant completely caught up in a spending frenzy, sinking unbelievable amounts of money into data centers and artificial intelligence infrastructure. But if you look under the hood, you'll find that this massive cash drain is actually masking one of the most aggressive and profitable structural margin booms in modern financial history. We're going to break down exactly what the market is missing today and why this apparent weakness might actually be an absolutely insurmountable moat. Let's dive into it.
$220 billion. Think about that number for a second. That is Amazon's guided capital expenditure for the full year of 2026, directly upgraded by CEO Andy Jassy from a previous $200 billion target. To put that kind of scale into perspective, Amazon is aggressively plowing more cash into its infrastructure in a single year than the entire market capitalization of most Fortune 500 companies. This is exactly where the tension lies for investors right now. Where is all this money actually going? Well, it's being hyper-directed into AWS data centers, generative AI servers, and the massive utility grids needed just to power them.
And here is the immediate consequence of that spending, which has triggered the central market conflict we're seeing. Trailing 12-month free cash flow has swung to a negative $7.6 billion outflow. Just a year prior, this was a positive $18.2 billion inflow. So the ultimate market disconnect is this. Why is a multi-trillion-dollar juggernaut suddenly draining cash so aggressively? The bear case argues that Amazon is simply overbuilding, caught in this massive AI hype cycle that won't actually deliver a return on invested capital. But they are completely missing the other side of the ledger.
Because here is the pivot point for this entire thesis. 13.7%. That is Amazon's consolidated operating margin for the second quarter of 2026. This isn't just a slight beat. It's a massive, massive expansion from the 11.4% we saw in the prior year. This proves that the $220 billion Capex isn't some reckless mistake. It's a calculated infrastructure war, and it's being funded by a massive, hidden structural margin boom. Amazon is showing immense operational leverage because its core mix of businesses has fundamentally shifted.
To really understand this, we need a quick context check on how Amazon actually makes its money today. For years, the market priced Amazon as this low-margin retail distributor. You buy something, they ship it in a brown box. But the reality of their operating profit tells a completely different story. AWS, their cloud computing division, generates a staggering 60.7% of the company's total operating profit. North American retail, despite its massive global scale, only accounts for 33.1%, and international brings in 6.2%. The retail logistics network is the foundation, sure, but the true economic engine, the part of the business that is actively subsidizing this massive AI build-out, is the cloud and those high-margin services. Let's break down those highly profitable engines driving the business right now. Yes, the traditional first-party online stores are still the volume leader, pulling in $69.92 billion. But the real story here is the explosion in high-margin services. Third-party seller services brought in $46.78 billion. AWS delivered $42.23 billion, and then there's advertising services. They are capitalizing on highly measurable transactional search data, hitting $19.81 billion. Even subscription services, anchored by over 250 million global Prime members, delivered $13.73 billion. This brilliantly illustrates that Amazon is no longer just selling you items. They are selling digital real estate, computing power, and advertising space at incredibly high margins.
So, the crucial question becomes, how does Amazon defend these high-margin fortresses? Well, the structural moat in cloud computing right now is being defined by vertical integration into custom silicon. Meet Trainium and Inferentia. These are Amazon's proprietary, custom-designed AI microprocessors. By designing their own chips from the ground up, instead of relying solely on external hardware vendors, AWS completely bypasses those massive premium markups we see in the broader market. This gives them an almost insurmountable cost-to-performance advantage. It allows them to offer high-intensity computational queries for AI models, the heavy lifting required to run complex apps like ChatGPT at a fraction of the cost. And that makes AWS incredibly sticky for enterprise clients.
Which brings us right to the central conflict the market is wrestling with today. The bear case fears a massive AI overbuild. They look at that $220 billion spend and see a huge risk of stranded data center assets. We're talking servers just sitting idle, gathering dust if the AI revolution slows down and no one actually rents the compute.
But contrast that fear with the bull case reality. On the recent earnings call, management explicitly stated that the soaring demand for AWS training and inference capacities means their enterprise capacity for 2027 and even portions of 2028 is already fully reserved under long-term contract structures. Let that sink in. They aren't building on speculation. They are building to fulfill contracts that are already signed and locked in.
Let's move to the hard evidence and see exactly how this builds out in the actual numbers. On July 30, 2026, Amazon reported its Q2 results, and honestly, they were staggering. Consolidated net sales hit $200.61 billion. That is a 20% year-over-year revenue growth, which comfortably beat Wall Street's consensus forecasts. Now, this acceleration was partly aided by the strategic shift of the Prime Day promotional window into the second quarter. But make no mistake, the underlying organic demand was incredibly robust.
And that top-line growth translated beautifully to the bottom line. Consolidated operating income just rocketed to $27.5 billion. That is a massive 43% increase over the $19.2 billion they reported in Q2 of 2025. This was the exact moment the market realized the high-margin transition is actually working. And by the way, if you like deep evidence-based stock breakdowns like this, make sure you're subscribed.
The undisputed star of that July earnings print was AWS. The momentum here is undeniable. AWS grew 37% year over year. That is the fastest expansion rate for the cloud segment in 18 quarters. But even more impressively, AWS posted a 39.3% operating margin. This completely shatters the market anxiety that cloud computing was becoming some commoditized, maturing utility. Instead, what we're seeing is that the generative AI infrastructure build-out is already yielding historic returns and aggressively accelerating their growth.
The immediate market reaction tells you everything you need to know about how misunderstood this margin dynamic was. Shares surged 9.15% in after-hours trading, hitting $257.04 on July 30th. This was a massive relief rally. Sell-side analysts scrambled to revise their 12-month price targets upward, moving the consensus average to $317.48, with premium targets topping out at $370. The market suddenly, finally, recognized the cloud and advertising utility hiding right beneath that retail exterior.
Taking a step back from the raw numbers for a second, our qualitative scorecard reveals an exceptionally durable business. Amazon boasts a flawless track record, systematically compounding capital for decades. Its revenue quality and market position are elite, and that's largely driven by the fact that over 60% of their operating cash flow is now underpinned by highly predictable utility-based AWS contracts and those Prime subscriptions. Plus, they hold nearly 38% of US e-commerce. And financially, despite the massive spending, they are remarkably healthy, holding a $78.2 billion cash fortress directly on their balance sheet.
But no company is perfect, and the scorecard also highlights some genuine structural concerns that definitely require attention. Management alignment is softer. While executives are compensated in long-vesting restricted stock units, proxy advisors have pointed out a lack of concrete performance-related metrics. Furthermore, there has been zero net insider buying over the past year. None. Only systematic insider selling. Capital allocation is also a pressure point right now. While the infrastructure spend is strategically necessary, absorbing these massive upfront costs is a heavy near-term drag on return on invested capital, and that's exactly what is driving that negative free cash flow metric we discussed earlier.
All of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, quality businesses built to compound for years, hidden gems, under-the-radar names with asymmetric upside, and dividend hunters, durable income with the fundamentals to back it up. Premium also gives you Portfolio Watch to monitor your portfolio and flag important changes, and Insider IQ to track meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this explainer. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. Okay,
Let's look at where this is all heading. We are going to walk through a 5-year mathematical scenario model projecting out to 2031. But before we begin, I must clearly state, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is absolutely not financial advice. The stock could go much higher or much lower than any of these scenarios. This is simply a tool to understand the operational math. And if you want the full model with all the detailed assumptions, you can check out the free report at flash.StockSentinel.ai.
When we project a 5-year mathematical scenario out from a baseline of $235.50, 3 distinct paths emerge. The low case drops to $126.18, the base case climbs to $330.95, and the high case rockets up to $560.59. When you actually probability weight these outcomes, the mathematically expected blended 5-year target price sits at $347.41, which implies a really robust 47.52% total return. But what actually has to happen operationally for these numbers to become reality? Let's break it down.
Let's start with the base case, which we assign a 55% probability. Operationally, this assumes consolidated revenue compounds at an 11% average annual growth rate, reaching $1.39 trillion by 2031. Crucially, it assumes the massive AI capital cycle normalizes, which allows GAAP net margins to settle at a very healthy 10%. In this scenario, the market awards a reasonable 25x price-to-earnings multiple. And because Capex scales down post-2028, cash flow turns strongly positive again, allowing Amazon to retire shares, reducing the count to $10.5 billion. This smooth compounding of both the AWS and retail flywheels is what gets us to that $330.95 target.
Now, the high case carries a 25% probability. This is the scenario where AWS custom silicon entirely dominates the computational landscape, stealing massive market share because of its severe cost advantages. Here, sales compounded a 14% average annual growth rate, pushing total revenue to nearly $1.59 trillion. Because the revenue mix skews so heavily toward high-margin AWS, advertising, and the successful launch of Project Leo's satellite broadband, net margins expand to 12%. The market absolutely rewards this hyper-growth and superior return on capital with a 30x PE multiple. Massive free cash flow funds aggressive buybacks, and the stock hits $560.59.
But we absolutely have to respect the low case, which holds a 20% probability. This is what it looks like if the thesis fundamentally breaks. Sales growth drops to a conservative 7% average annual growth rate. That aggressive AI build-out, it fails to generate acceptable returns, leaving Amazon with stranded, unused data centers. Meanwhile, severe utility pricing wars with Microsoft Azure and Google Cloud permanently compress their margins. Net margin falls to 6%, and the market compresses the valuation multiple down to 20x PE. Without free cash flow to fund buybacks, stock-based compensation dilutes the share count up to 11 billion, and the stock bleeds down to $126.18.
And that leads us directly into a concrete risk analysis. What could actually break this thesis? First is regulatory risk. The FTC antitrust trial is scheduled to proceed in mid-2026. The ultimate damage here would be a federally mandated structural breakup separating AWS from retail or a court-ordered cap on third-party merchant take rates. Second is AI Capex execution. An early warning sign investors need to watch for would be structural asset impairment charges. That would tell us the AI cycle was indeed overbuilt. Third is competitive cloud pricing compression. If AWS's average contract value suddenly top, that premium 39% operating margin could commoditize incredibly fast.
There are also macro and concentration risks we can't ignore. Amazon carries $128.9 billion in long-term debt. A structural rise in borrowing costs while simultaneously needing to fund this massive Capex cycle could force a real liquidity constraint. Furthermore, AWS has major customer concentration with private AI startups. Think about their massive multi-year commitment with Anthropic. If venture funding dries up and these leading AI labs face financial distress, it would instantly vaporize billions in projected AWS demand. Finally, a global stagflationary environment would simultaneously depress enterprise IT budgets and consumer discretionary e-commerce spending. It's a double whammy.
So, as we bring this all together, here are the 3 most critical takeaways that resolve the mystery of this massive cash drain. Step 1. The $220 billion capital expenditure is a moat, not a mistake. It is backed by fully reserved enterprise contracts for the next 2 years. Step 2. Amazon's vertical integration into custom silicon and retail advertising is driving a structural 13.7% operating margin boom, fundamentally changing the company's profitability profile. Step 3. With 37% year-over-year growth, AWS is actively accelerating in the AI era, aggressively defending its crown as the dominant cloud provider.
Moving forward, if you are tracking this company, there is really only one metric that matters above all else. You must watch if AWS can maintain that 37% growth rate in the upcoming quarters. As these massive multi-year enterprise contracts begin to actually monetize, sustained top-line growth will be the ultimate validation that the heavy capital expenditure is paying off and converting into long-term, high-margin cash flow.
The market priced Amazon as a low-margin retailer, completely missing the multi-trillion-dollar cloud and advertising utility hiding underneath. A short-term cash drain is actually funding a long-term structural margin boom. The only question left is, how much of the global AI infrastructure will Amazon own when the dust finally settles? If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.